Hi, this is Scott McLeod with Brown Financial Advisory. Wanted to share with you just some information about the upcoming election. We've got the presidential election and congressional elections next week, and I know that some of you have been a little concerned about the candidate that you prefer not making it in and what might happen to the markets and so forth. And I found a very interesting slide deck that I wanted to share with you, and we're going to spend just a few minutes talking about one specific thing that we know to be true after 25 years of experience, and that is that the just like this election, the previous elections, people really, really care about the elections and the policies, but the market generally does not. And so I want to share with you just a little bit of information that we've received from Invesco recently, and I think it'll help you understand how the election might impact the markets in your portfolio. So let's get started. First thing, just a few disclosures. And this is a slide deck from Invesco, and you probably know that we don't have any relationship with Invesco to speak of, but this is a slide deck that we can use, and they're happy for us to use it for you. So just to share some odds and ends. And the first thing that I want to tell you is that some of these concerns, the things that you've talked with me about, are really not new, and they're very common throughout various election cycles. They feel very important to us right now, and they always do. But it's interesting because Josh Lancaster and I were talking this week, and we've both been doing this for over 25 years. And for 25 years, we've had similar conversations around the election cycles. The questions come up very often. But this is an interesting slide deck that says, what do you think the most important problems facing the country are right now? And the Gallup poll said the economic problems, the economy in general, of course, the high cost of living and inflation, the federal debt, non-economic, specifically immigration, poor leadership, a divided country. How do we fix those things? But if you go all the way back to our founding fathers, it's interesting to see that they were saying the same things all those hundreds of years ago. Thomas Jefferson talking about the central bank messing up our economy and being against our Constitution. James Madison even said public debt is a public curse. And then I love this. Ben Franklin said inflation is a gradual tax upon them. And I would have to agree with that. And even Alexander Hamilton, way back in the beginning of our country's birth, said immigration has served very much to divide the community. It's the same discussions we're having today. So these things, these topics are not new. It doesn't mean that they're not important. It just means that it's a common refrain in our country and has been for many, many years. So how does that sort of refrain and those items affect the market? And this is where it gets interesting. We tend to think that one market will outperform, or excuse me, one party will outperform another party in the stock market because of the policies that they implement. But if you look at these policy performances and these different Democratic and Republican administrations throughout time, if you go back since 1961, this particular graph goes back to many of these administrations that we would consider either very pro-market or even against the market. And you'll see that there's a good blend of blue and red all throughout these performance numbers, with the annualized stock market performance pretty consistently being above 10% for most of the parties. The annualized GDP growth averaging somewhere here in the 2.5% to 3%. Johnson and Kennedy had excessive growth, but most everybody's kind of in this 2.5% to 3.5% growth rate. There isn't a lot of difference from party to party, and this is very consistent across the whole market and over this very long time frame. If you also look at the range of returns for different administrations, you're going to find the same thing. So going back to the Kennedy administration, you'll see that these returns range from what is an average of about negative 19.4 all the way up to almost 44%. And you'll see that these are very consistent averages. The the Ford administration was pretty tight. The Nixon administration was pretty wide, and generally they're kind of falling in those ranges. The Bush administration had a significant decline here, but a pretty good increase too. And you'll see during those administrations, we see a very consistent, very repeatable and predictable performance on the stock market over those time frames. So it's not a single president's policies, not a single president's administration that drives the performance of the stock market. And it becomes more and more evident as you look at each of these graphs. So the question then becomes, well, should I get out of the market? You know, we've had a few people ask, well, I don't want this candidate to win, and therefore, if they win, maybe we should get out of the market. I love this graph because basically what it just says is what happens if you're only invested during a Democratic administration or only invested during a Republican administration. I think intuitively we know the stock market goes up during those administrations in most time frames. So if you're fully invested, of course, your results are going to be better. This is going back from 1900, but if you are only invested in the Democratic or Republican administrations, you can see that your performance is terrible, really awful. But if you come down here and just look at the past 127 years, you can see that that's an incredible result. $10,000 back in 1900 would be well over $10 million today. So this is a stark contrast. It's basically just saying being invested, and as we've said before many times, being time in the market will always outperform timing the market. Even if you're concerned about the short-term impact, time in the market will always outperform time in the market. And one of the things that I also hear often, almost every election cycle, is, Scott, this time it's different. And my response to that, as you know, is always, well, it's different every time, and that's what kind of makes it the same. And that's what we've seen, especially in the last couple of administrations. So this slide actually describes what happened during the Trump administration and the Biden administration. And you would consider those two candidates very, very different policies, very, very different approaches to governing. And yet look at these stock market returns from the beginning of their administration to just recently. This is up through June 30th for the Biden administration. But you can see they both rose during this period. It looks like the Biden administration fell right here, but the Trump administration fell right here. So they ended up kind of at the same spot here in terms of growth. And all the way up to COVID, they just mapped each other's performance just beautifully. I mean, it's so close all along the way. It just should tell you that the president has limited control over what's really going to happen in the markets. The president's going to drive policies, and we may or may not like them. We may or may not like the tax rates. We may or may not like the social policies that they implement. But basically, when you look at the stock market, it's going to run independently of many of those policies. Will it have an impact? Yes, it'll have an impact. But what impact really is it beyond what the market was going to do anyway? And you can kind of see what's happening here. And were it not for the COVID right here with the Trump administration, those two graphs would look very, very much alike. So the next thing that I'd like to talk with you about is the sector betting. And this is another thing that we discourage our clients to do. What often seems obvious in the market is really just smoke and mirrors. And one great example of that is clean energy versus oil and gas. And, I think we sort of pigeonhole a little bit. The Democratic Party is all about the green energy, and the Republican Party is really more about oil and gas and supporting the oil industry. Well, isn't it interesting if you look at the stocks that are related to these two different approaches, if you will, to producing energy under the Trump administration? Lo and behold, the clean energy index outperformed the oil and gas index over his whole administration. And then you look at the Biden administration, which you would expect would be all clean energy. And lo and behold, it's exactly the opposite. Oil and gas outperformed during the Biden administration, and clean energy underperformed. Negative for oil and gas under the Trump administration, negative for clean energy under the Biden administration. And the takeaway is that the president, despite his energy and focus on expanding one or the other or some policy over another policy, the stocks, valuations, inflation, market environment, supply and demand, all of those things are really driving those stock prices, not the president, not the administration. There are incentives here and there. I mean, if you look at the tax incentives that have gone into green energy, you would say, well, certainly green energy will outperform under those tax incentives. Well, clearly it has not in the last 4 years, especially. So it's interesting to see that contrast. And what you think might be obvious on the surface is never quite as obvious as it seems when it comes to the stock market. So here's the thing to remember. The US economy is not radically re-engineered by any single party or any administration. One of the best takeaways from this slide deck is this percentage of total US spending for major GDP components dating back to 1956. And this is incredible. This is consumption, government expenditure, and business investment. And if you look at these numbers, they have changed very little over this time frame, this almost 70-year time frame. Very little. The government has spent about this much. The businesses have spent about this much, and the consumers have spent about this much. You'll see consumer spending has increased over that time frame, and our population has too. So you would expect a little bit of that relationship. But those time frames are a mix of Republican and Democratic administrations with very different policy ideas. And what has it done? Not really much at all in terms of spending with regards to GDP. And GDP, of course, is the country's growth and how we continue to move forward. It enhances what happens with companies and it creates an environment for business. And those things have not changed over the last 70 years, as you can see here, regardless of what's going on in the administration. Wouldn't you expect that to just really modulate a lot across the administrations, but it does not. And that's the most important takeaway with regards to what happens to our country's economy as it's driven by GDP. This is a great example of how things really kind of move in spite of the administration, not really with the help of the administration. No party can claim fiscal responsibility either. So another one of the concepts that I have to address in conversation often is, well, if this administration gets into the White House, what happens next? Or if they control Congress, what's going to happen to our debt? What's going to happen to our deficit? And here's the big takeaway on this. Of course, the federal debt has grown, and that's a big concern for all of us. The interest service on the debt has also grown, and that's a big concern for all of us. But if you go all the way back to 1961, and the Kennedy administration, you can see that across both different parties, both parties have had a part in expanding the debt. Now, sometimes it's a little less than others. So you can see here when the receipts exceeded the federal outlays is rare in our country. And you can see there was a point here and there's a point here in the Clinton administration that those two things happen. And then as you see the deficit growing and contracting and growing and contracting as we go along, this is an important component and it will change from administration to administration, but there's no clear path to say the Republicans are always better at the deficit or the Democrats are always better at controlling the deficit. The one big takeaway, though, that I love with this graph and the thing that is important for you to remember is that the current interest outlays on as a percent of GDP. So in other words, when you consider our government debt and how much we pay in interest payments as a percent of our country's GDP, just how much we produce, the gross domestic product, it's only 2.4%. 2.4% of our GDP is contributed to the interest on the debt. Now that number in 2024 is projected to be closer to 3.1. So it is growing, and I'm not a big fan of that, I have to confess. But when it comes to the risks of it, the takeaway is, as Invesco has said here, it's a relatively low bar for our growth to surpass. As the growth improves, it becomes a smaller percentage of that total. And we have control of it. It's not out of control yet, but we want to be fiscally responsible. And that doesn't necessarily mean it's one administration over another. Both of them have contributed to that deficit over time and contributed to the debt over time. Now, policies related to the White House are important, but you know what matters more? Monetary policy. So monetary policy comes in a situation when we're considering the different things that are related to monetary policy. So risk-free interest rate, the yield curve, exchange rate, credit spreads, equity valuations. That's an important part of the administration, and that contributes to performance or lack thereof, because the Federal Reserve, for example, can tighten the economy by raising interest rates as they did in 2022, slows the economy down, cuts the performance of the stock market. It does all these things, or they could loosen it like they did after the Great Recession in 2008 and just spark a growth surge in the market. And a lot of that depends on what's going on in the current environment. So monetary policy matters a whole lot more than who is in the White House or who's controlling Congress. And here's a funny takeaway. Really, the markets don't care who you like. Ultimately, the Gallup poll approval ratings have what's interesting, a very counterintuitive result on the stock market. If you look at the approval ratings when they're super low, the stock market's not happy at all. Or maybe it's the other way. When the stock market's low, they're not happy with the president. But if you have kind of a middling, if you will, approval rating of 35 to 50% since 1961, that's when the stock market outperforms. So you don't have to be a great president. You just kind of have to be mediocre. When it's over 50, it's only 6.6%. So it's interesting that the market really doesn't care if you like the president. It's going to do its own thing, and it's going to do it because of valuations, because of earnings growth, because of an environment that promotes capitalism, and that's what the U.S. embodies overall. So more important than what the administration does is when the administration starts. So coming off a recession, for example, a time when the market has contracted and the economy has slowed down, is really the best time to become president. First of all, you can take credit for making things better, whether you've really had anything to do with it or not. But the stock market is on a bounce, so valuations are cheap. The market's ready to outperform again. Things start to turn in a positive direction. As I mentioned, monetary policy, the Federal Reserve is probably stimulating the market. And here are some really great examples of this. If you look from 1981, growth had been slow, and Ronald Reagan comes in and he sees 207% cumulative price performance on the stock market. Barack Obama, 234%. But look when he came in. He came in 2009 after the stock market had been murdered by the Great Recession, down over 50% during that 2-year period. And he comes in right after that in January of 2009. And what happens? The market bounces and we see these incredible returns. Was that Barack Obama, or was that just a stock market bounce? Well, I would argue that it was just a stock market bounce. Valuations were cheap. The Federal Reserve was lowering interest rates. The market was ready to recover. The housing market had finally hit a bottom. We were starting to see all these things come together, and it just so happened that Barack Obama was the president. And the stock market went on as it normally does. So the big takeaway, the number one thing is this is a great country. It's a great place to live. It is business oriented. We have low tax rates as compared to the rest of the world. And it is a ripe environment for ingenuity and investment. And that's what we're seeing in this country. And we're seeing everything in all these different administrations. We're seeing products that are being produced and services that are being created for our environment. And you see things like cloud computing over the last, really just lifetime, tablets, fitness trackers, ride share, electric cars, virtual payment systems, go on and on and on and on, that are being produced by companies in this country, in the United States. And they do it because as long as there's an environment where you can make something and sell it to somebody for a profit, or provide a service and do that as a profit center, that's an opportunity for that stock price to grow. That's an opportunity for the company to expand and the S&P 500 to continue going up. And the president and the Congress will not prevent that from happening. It's driven by capitalism, and it will drive right through the administration. And as I've said many times before, it doesn't really matter the environment. We'll figure it out from there, just like the tax rates. We'll find strategies to save taxes. If the tax rates go up, we'll find strategies to save taxes. If the stock market changes, we'll find opportunities in the market. But the idea is capitalism will continue to drive the market in spite of the administration and in spite of what's going on in the White House and Congress. So I want to thank you for the time. I hope this is reassuring. The takeaway is vote your convictions, vote on the policies, and don't vote on your portfolio. Your portfolio will be fine through the changes and through the administration. And if history is any indication, it'll work out just fine in your favor over time. And you just vote what's important to you in your heart. And we'll all pray that it all works out great for the country as it has in the past. So please let me know if you have any questions, and I'll look forward to talking with you again soon.